Today, we're diving deep into a fascinating and often brutal market phenomenon, perfectly illustrated by recent events with Spero Therapeutics, ticker SPRO. This small biotech company just received crucial FDA approval for its groundbreaking antibiotic, Utebzi, yet its stock plummeted over 25% on the news. This isn't a story of failure. It's a textbook example of sell the news, and it presents a unique opportunity for those who understand its dynamics. We'll break down why this happened, what it means for SPRO, and whether this drop is a gift for long-term investors or a warning sign to avoid. In the world of investing, few phrases are as critical as buy the rumor, sell the news. This isn't just a quirky market saying, it's a predictable life cycle. Speculators drive up a stock's price based on future expectations. When the anticipated news finally breaks, the upside is already fully priced in. Buying pressure vanishes and profit takers flood the market. Biotech stocks are especially vulnerable due to their reliance on binary catalysts like FDA decisions. A company transforms from a speculative story into a slow-grinding commercial business. This transition often sparks aggressive profit-taking. But biotech isn't alone. The crypto market sees it with network upgrades and ETF approvals. The video game sector experiences it after highly anticipated game launches. Even big tech like Apple can see stocks tick down after major product keynotes in. Commodity markets also show it with policy announcements or crop reports. In all these cases, the drop isn't about the quality of the news itself. It's a structural liquidity event driven by short-term trading capital exiting the field. To truly understand why SPO crashed today, we have to look at a famous historical blueprint, Madrigal Pharmaceuticals, ticker MDLVL. Ahead of its highly anticipated PDUFA date for its groundbreaking liver disease drug, Rezdiffra, speculative money aggressively bid the stock up from $170 to a peak of nearly $300 a share. When the FDA officially granted approval, a massive historical win, the stock instantly dropped over 15% in the following days, tumbling back toward $240. Lesson 1. The devil is in the label. The FDA approved Madrigal's drug, but included restrictive criteria regarding which stage of liver fibrosis qualified for coverage. This meant the commercial rollout would be slow and grueling. Lesson 2. The character of the shareholder shifts. An approval marks the exact moment a stock stops trading on infinite speculative hype and starts trading on boring commercial execution. Fast momentum money exits and slow value investors take their place. Spero Therapeutics is the pill that empties hospital beds. Their flagship product, Utebzi, just received FDA approval. It's the first and only oral carbapenem antibiotic approved in the USA. Utebzi targets complicated urinary tract infections, or CUTIS, including severe kidney infections. Its core value proposition is clear, allowing patients to transition from expensive IV infusions in hospitals to oral pills at home. This is a significant logistical and economic disruptor. The potential market is substantial. Over 3 million QT cases are treated annually in the USL alone. Up to 1 million of these are caused by multi-drug-resistant pathogens. These are the cases where traditional oral antibiotics fail. However, Utebzi's approval comes with a restrictive label. It's specifically for adults with limited or no alternative oral options. This means it won't be a first-line treatment for standard UTIS. It will be positioned as a Tier 3 reserve antibiotic. Spero partnered with pharmaceutical giant GSK for commercialization. The deal includes a $66 million upfront payment and a $9 million equity investment. Spero is also eligible for up to $525 million in milestone payments. These milestones are tied to clinical progression, first commercial sales, and achieving specific annual net sales thresholds. Spero will also receive tiered royalties on all net product sales. These royalties scale from low single digits to low double digits. The top tier, low double-digit royalty bracket kicks in if global annual sales clear $1 billion. GSK plans to make Utebzi available to U.S. patients by the end of 2026. Looking at the charts, SPRO's drop was sharp and immediate. The stock had been trading in a range between $2.7 and $3 ahead of the PDUFA date. Following the FDA approval, it sliced clean through its key technical support level at $2.69. This triggered stop losses, accelerating the downward momentum. The stock closed down at $2.12 per share. This occurred on massive trading volume of over 10.4 million shares. This volume dwarfs its 3-month average of around 550,000 shares. The current price sits at $2.12. Immediate overhead resistance is now firmly established at $2.69. The next significant technical support level is the 52-week low at $1.8. For those considering an entry, waiting for the high-volume selling to exhaust itself is crucial. A brief dead cat bounce back towards the $2.3 to $2.4 range is possible. For long-term accumulation, patience is key. A smart strategy would be to scale in slowly if the stock stabilizes between $1.9 and $2.1. Always keep a strict eye on that ultimate 52-week support floor at $1.8. The objective is to let the market digest the news and for the stock to form a technical base. Let's look at Spero's financial resilience. Following the 25% drop, Spero's market capitalization sits at roughly $123 million. The company ended the first quarter with $56.1 million in cash. Crucially, the $51 million regulatory and first sale milestone from GSK is now officially unlocked. This immediate cash infusion brings Spero's near-term cash assets to over $100 million. This substantial cash cushion extends Spero's cash runway into 2028. It effectively eliminates the immediate threat of dilutive equity raises. This is a rare and significant advantage for a microcap biotech. The operating business and future GSK royalties are now valued at a microscopic enterprise value. Prior to the narrow label constraints, unadjusted peak sales, estimates for an oral QD carbapenem range from $300 million to $500 million, $500 million annually. The structure of the Spero GSK milestone agreement itself suggests higher potential. Commercial net sales milestones scale up to a $1 billion ceiling. This indicates the companies realistically expect Utebzi to achieve blockbuster status for Spero to unlock its top-tier royalties. When evaluating Spero now, we see a clear divergence in perspective. The bullish argument centers on a significant valuation disconnect. With over $100 million in cash and a de-risked balance sheet, the market is essentially valuing the core operating business and all future royalty streams at a minuscule enterprise value. This cash runway into 2028 removes immediate dilutive financing risks, a major hurdle for many small biotechs. For patient, long-term investors, this could represent an opportunity to buy a fundamentally sound business at a steep discount. However, the bearish outlook highlights immediate challenges. The sell the news event means the immediate catalysts are gone. GSK's commercial launch isn't planned until late 2026, creating an information vacuum. This lack of near-term news could lead to the stock drifting sideways or even lower. The FDA's restricted label, specifically for patients with limited or no alternative oral options, will slow the initial commercial ramp-up. This has led to adjustments in near-term revenue models, with fair value estimates often cited around the prior $2.69 support level. The market must now digest these lowered short-term expectations. The consensus is that the stock's recent decline is primarily a function of market structure and profit-taking, rather than a fundamental flaw in the approved drug itself. While the news dynamic creates opportunity, risks remain. The most immediate risk is the dead money phase. With GSK's launch in late 2026, there are no significant near-term catalysts to drive the stock higher. This could lead to a prolonged period of sideways or downward price action. Commercial adoption under the restrictive FDA label is another key risk. GSK will face the challenge of convincing hospital pharmacy committees and insurers to use Utebzi as a Tier 3 antibiotic. If adoption is slower than expected, it could impact future milestone payments and royalty streams. Although Spero's balance sheet is de-risked into 2028, any major unforeseen delays or commercial setbacks could eventually necessitate future dilutive financing. Technically, while $1.8 represents a 52-week low support, a breach of this level could trigger further selling pressure. Finally, while the FDA approval is a major hurdle cleared, competitive landscape changes or new clinical data from rival treatments could emerge in the coming years. The SPRO case is a powerful lesson in market mechanics. It beautifully highlights the critical difference between a company's operational success and its short-term stock performance. If the FDA had rejected Utebzi, SPRO's stock would have plummeted far more significantly, likely 40% to 60%, based on fundamentally bad news. Instead, we saw a 25% drop despite a positive approval, driven by structural the news dynamics. This means the underlying business is fundamentally sound and de-risked. For long-term value investors, these structural sell-offs, once the initial selling pressure is exhausted, can provide highly lucrative entry points. The key is patience, allowing the short-term speculative money to clear out. Then the stock can transition to a more stable shareholder base focused on the long-term execution of the business. By understanding these patterns, you can learn to distinguish between a broken company and a temporary stock market anomaly. Keep learning, keep growing, and I'll see you in the next one.